I will start a series on options, and today's episode will explain the meaning of options, call and put options, and the relevance of option to you as a stock investor. Welcome to my channel and please subscribe. Option is a financial contract that gives or empowers the buyer to sell other shares of stocks at option strike price at or before a specified time period. Now I will explain the key words in this definition. Strike price is the price at which an option buyer can buy or sell other shares upon exercising the option. It is a lay-down principle. Specified time is the date at which option policy ceases to trade on the market or expires worthless. Option is an effective stocks management tool employed to magnify returns by both investors and traders. However, for now, I will concentrate on stocks investors. Investors can use option to hedge their investment portfolio, meaning option is an insurance policy you can buy to protect your investment. For instance, if you buy an insurance, you will pay a premium, and if the market goes down or crash, you are not affected because you have insured your portfolio. Let me illustrate. For example, if you bought stocks of a company worth £500,000 and with a potential recession in 2020 that looks likely to crash the market, which could inevitably reduce the value of your stocks and your portfolio by half or more. Therefore, as a long-term investor, the best investment strategy is to buy a put option to insure your portfolio at £500,000. The put option you bought is a guarantee and insurance to protect your 500,000 investment if the market crashes. It is a win-win scenario. Option can be used to generate additional income called selling cover calls. You can gain some additional 20 to 30 returns on your portfolio by collecting premiums, by selling call options on your stocks. You can also use option to buy stocks at a discount. Let's illustrate. Let us say Imperial brand is now selling for £16 and you think the price is too high. You believe it is worth £14. With put option, you can collect premium and buy it at a big discount. Yes, it is possible with this strategy, and I will discuss it in part 2 and 3. We have two types of options, namely call and put options. And with the two options, you can buy a call options known as going long on the call, or you could sell a call options known as shorting a call or write a call if you like. And again, you can buy a put option known as long, or you could sell a put option known as going short on a put options. Now, let me break it down. Remember the previous definitions of options. This time around, let's relate it to a call option. So, when, as an investor, you buy a call option, it gives you the buyer the right to buy other shares of stock at a specific price. You lock in, which is called the strike price. Here's the key. you must do it before the specified date. Let's say Netflix is now selling at $400. Meanwhile, you are bullish on Netflix because you think Netflix would appreciate, but you don't have the $400 to buy Netflix. Now here's how a call option strategy becomes very reliable too. You could buy Netflix $400 call. The $400 call means the strike price, the price at which you lock in. In effect, when you buy this call option, you now have the right to buy Netflix at $400. Meaning, if Netflix goes up to say $500, $600, and $700, you are allowed, it's your right to buy Netflix at $400 and sell it at the current high price. Okay, here's the key. You must carry out this transaction before it expires at a set date. And to initiate this call option, there's a price attached to it, which is called premium. Meanwhile, I will provide you with a snap view of how to read an option. This is Netflix, August 200 call, and is selling at $10. The first thing you see on the table is the stock with the ticker symbol NFLX, which means we are buying option on Netflix shares. Next is the date of expiration. Note, option always expire on the third Friday of every month. Next on the table is the strike price, the price at which you lock in. And again, you can choose whatever strike price you want. Next is the call. In this case, to buy Netflix August 200 call, it will cost you $10. And it is called premium. However, here is the key takeaway in this episode. Options are contract, giving the buyer the right to purchase and sell an underlying asset, e.g., 100 shares of specified common stock at a fixed price, the strike price, on or before the given date, the expiration date. Okay, here comes the best part. Please subscribe. Remember, the goal is to generate wealth, build companies, and create jobs. Bye now. See you soon.